So last year, BlackRock created a Metaverse ETF just kind of out of nowhere. I think they probably saw the huge popularity of artificial intelligence and all the rising investments into those areas, including the Metaverse too. And because they're already the world's largest asset management company and the second largest issuer of ETFs, with their iShares ETF division, well, it just makes perfect sense that they would also want to have an ETF for the metaverse as well. But as popular and as really a meteoric of a rise that AI has seen this year, it's kind of overshadowed the metaverse a bit, and I feel like it's being talked about a bit less than it used to be. The metaverse I'm referring to, of course. In fact, even with many AI stocks soaring this year, this particular ETF is actually flat in performance, but hey, that may actually present a good buying opportunity for the long term, right? Given that companies seem to still think that the metaverse will play this really major role in the future of technology. In fact, analysts at McKinsey think that the market for the metaverse will be worth trillions of dollars over the next decade, with already hundreds of billions of dollars of investment being poured into these new technologies by many companies all around the world. Now, as for me, I actually had several viewers ask me to give my opinion on this ETF throughout last year, and I just never really got around to making that video for you guys, so I do apologize for that. To be honest with you, I just didn't really think that it would be a very popular video to make. But, given that the ETF is having a weak year here in 2024, I'm actually thinking that this might be a more pivotal moment for the ETF, and that might be something that's worth discussing. Like, are investors dismissing what could be a great investment opportunity here for the long term? Or is this more of another just kind of mediocre ETF that may perform well over time, but isn't all that necessary to really be buying as investors, and maybe just kind of picking some of the best holdings from the ETF might be a better strategy? What's the right answer here in terms of those questions? Well, I'll dive into all of this. I'll give you my overall opinion on this ETF. We'll talk about some of its characteristics, how the ETF is structured. We'll take a look at its various holdings, and I'll give my opinion on some of them. We'll do it kind of rapid fire style. And of course, as always, I'll let you know if I plan to buy this ETF myself too. Because by the way, you guys know that I'm not the biggest fan of ETFs myself, but this one would actually be the type of ETF that I actually do think is worth investing in, because it gives you specific exposure to a certain area rather than just tracking like the broader market as a whole, which I'm not a fan of myself. That's I would say less necessary, less exciting, but something like this giving a diversified exposure to a specific area, in this case the metaverse, I actually do think that makes it much more interesting because of that. So let's go ahead and take a look at all of this, and let's see what we find here. So first of all, as this article from Seeking Alpha points out, BlackRock launched the ETF back in early last year. It was called the iShares Future Metaverse Tech and Communications ETF. The ticker symbol is IVRS. I usually just say IVERS. But anyway, they market this as offering exposure to companies both in and outside of the United States that provide both the hardware and the software used for and within the metaverse, which allows consumers to immerse themselves in a virtual world that's interconnected through digital platforms, social media, gaming, 3D software, and both augmented and virtual reality. Now, hopping over to the BlackRock website, we can see that it carries an expense ratio of less than 0.5%, which I actually do think is pretty good, especially for what this ETF is doing and compared to its peers. Now, I only know of a few other metaverse ETFs that I'm a little familiar with, but for example, there's like the METV ETF, that's the Roundhill Ball Metaverse ETF. There's also VERS, that's the ProShares Metaverse ETF, and there's FMET, the Fidelity Metaverse ETF. Well, BlackRock's IVERS is not only cheaper than the median of all ETFs in terms of expense ratio, but it's also cheaper than these other peers except for Fidelity. Fidelity's Metaverse ETF, that one is slightly cheaper, but it also looks like IVERS does pay a tiny little dividend of about 0.3%, which it may not seem like that's even worth mentioning, but the only reason that I do mention it is because, well, number one, I wouldn't expect to even get a dividend at all for a growth-oriented ETF like this. I wouldn't expect to even get a dividend. So it's just kind of that nice little added bonus. But number two is that for as small as that little dividend is, it actually does help cover much of that expense ratio. So it's almost like there's no expense ratio because of that bonus little dividend. So I would take it. I would take that little dividend. Now, speaking about growth and value, well, that really is what this ETF is focused much more on, is future growth rather than value. And you can see that in the makeup of this ETF, which it looks like this ETF happens to track the Morningstar Global Metaverse and Virtual Interaction Index, which if we hop over to that index, well, it says that the goal of it is to benefit from metaverse platforms, enhanced social media, immersive gaming, 3D rendering and simulation software, wearable technology, and VR and AR, as well as digital assets and payments. All of that sounds good to me, by the way. Contrary to common belief out there, the metaverse isn't just about wearing a VR headset all day. It's all of these different giant markets being combined virtually and all the opportunity that comes from that, doing more business and sales and media and gaming and learning and advertising and being connected. All these kinds of things can be done much more virtually, and they will be done much more virtually over time. And by the way, that's not something that I'm particularly excited about myself, but that's just kind of the sad reality. The world is becoming more digital and more virtual, and that's just kind of the road that we're heading down. And I only see that getting larger, and I only see these other markets being integrated more heavily into that type of ecosystem of everything being digital and virtual and stuff like that. So I only see growth opportunities for all of that type of stuff. And I think that's where the metaverse really brings in a lot of value, how it can bring some growth and some new opportunities to already existing markets. And I think that's kind of the confusion that people have with the metaverse. They just expect it to be like putting on a VR headset. Oh, that's dumb. That's not something anybody's ever going to want to do. That's not really the point of the metaverse, at least for me. I think of it more as just kind of like presenting a new kind of growth opportunity, opening some new doors for already existing markets to become more digital, more virtual. And so all these different companies that interact with that type of stuff, I think they do have long-term opportunities for growth and stuff like that. And so having an ETF that takes advantage of all those different companies and puts them all into a basket, that could be something that's worth interesting. We'll take a look at all those individual stocks in just a second. But going back to the index here for just a quick minute here, around 61% of the index is in US stocks, while about 39% is in international stocks, which I do think is okay. I'd personally go much heavier in US stocks myself because I just generally trust them more. I feel like I would understand their businesses, especially here living in America. Might be a little biased because of that. But I'm just not one to have a lot of exposure to international stocks. So, that being at around 40% or so for international stocks seems a bit high to me, but I don't know, maybe, they're just kind of going for a diversified approach. So maybe that makes sense. Anyway, when looking at the value versus, value and kind of size matrix and looking at growth and stuff, well, it's circled in at mostly having large cap stocks that are focused much more on growth rather than value. And we can see more of that if we dig a little deeper here. The average market cap for these holdings is over 62 billion, which is a pretty large size, in my opinion. While over 30% of the holdings are in giant cap, 25% are in large cap, 35%, the biggest, is in mid cap. I like that. And then only 7% in small and 0% in micro, which I do have a couple feelings about all of this. Now, like I said, I do like the fact that the largest exposure here is to the mid cap. That's going to be a good balance there of size, but also growth opportunities. And then I like the fact that it's so heavy on giant cap and large cap. So the majority is going to be in safer, larger companies. I think that's a good thing because those are going to be very large, diversified, profitable companies in many cases. And so that's going to lower the risk for this index and the ETF that tracks it. So I can kind of see what Morningstar and BlackRock is doing here, kind of lowering the risk of it. The only thing that did kind of surprise me a little bit is that, the metaverse is this new technology of the future. You would think maybe there'd be a little more exposure to small cap and maybe even micro, because there might be some really young companies with explosive growth opportunities for the very long term for the future. But that doesn't seem to be the case of them focusing too much on that. Again, I think that's fine because you could still get tons of exposure to the metaverse with larger companies that are also diversified and they're not relying just on the metaverse. So that way, there's a lot less risk there because they can still be profitable through many other things that they do too. So it's a bit of a balance there, but I think it's overall okay. Now, going back to the index really quick here. Well, the average valuations are pretty high. Got a average PE of over 20, PB of over 3, PS of almost 4, and price to cash flow of almost 8. Those overall are pretty high levels, but you have to figure that these are growth-oriented companies. So if you want value here, well, you're really looking at the wrong ETF. What we really want here is to we're going to pay a little bit of a premium for something like this in terms of valuation wise, but the hope is that many of these companies could actually become very profitable over the longer term because this is the metaverse. There's going to be a lot of software in here. This is going to be a lot of software oriented companies. And so when you have that, you could end up with big software like margins once the metaverse really takes off in the future. So the ETF may seem expensive right now in terms of valuations of these holdings, many of these stocks, but over the long term, they could easily grow into those valuations. Again, if the metaverse really takes off and these are the right companies to benefit from that and from all those software like margins, if they can really start raking in huge profits over the longer term. Now, before we look into all of those individual holdings though, well, let's just take a quick glance at the ETF's performance since its inception. And we can see that since the start of last year, it's actually performed very well, having already risen by over 30%. However, year to date is a bit of a different story, with the ETF struggling this year to really gain any momentum. And it's basically fallen flat during that time here in 2024, which, by the way, compared to the broader market, it's completely underperformed, with both the S&P and the NASDAQ climbing by double-digit percentages each. Now, does that leave a good buying opportunity though, given the weak performance this year and looking out into their long-term potential? Well, we got to, of course, take a look at those individual holdings, and we got to see how I feel about their future potential and whether I agree with how the ETF is structuring all those different amounts and how much exposure they're giving to each stock. So let's take a look at them. So starting here, we can see that there are 42 stocks in total, with the top 10 making up just a bit over half of the entire portfolio, the entire index or the ETF. Those being Meta in the top 10. Meta is at number 1 at over 6%. I do agree with that. They've been spending probably the most amount of money just like purely on the metaverse alone. And of course, they also have billions of users on social media that can be targeted for that too, and they're very profitable. So I have no problem with Meta being at the top. Then also at around 5%, they have Krafton at number 2. I think they're Canadian. I might be wrong, but they're the gaming company that made PUBG. It's a really popular game. I wouldn't put them at number 2, though. I think that's way too high. I'm not sure why that's so high. There's also Roblox at number 3. I know why that's there, because Roblox is a games platform where users can make other games too, so it kind of fits perfectly with that metaverse theme, but I would not put them that high myself. They probably wouldn't even be in the top 5 for me, maybe the top 10, but I'm not even sure about that. They're kind of risky with a really expensive valuation and a lot of losses on the bottom line, so I'm not the biggest fan of Roblox. And we have Sony at number 4. Of course, that's the company behind PlayStation, which also has the PlayStation VR, so it does make sense for a lot of this, but it would not be in the top 5 for me. I would actually prefer Microsoft much more, who has Xbox. But then Autodesk is at number 5. They're pretty good. They're a world leader in 3D design, known for things like AutoCAD and other stuff like that. So that's a pretty good one. Then at number 6, we have Electronic Arts. That makes sense. Huge gaming company behind Madden, FIFA, and more. Another gamer in Take-Two at number 7. I actually own that one myself. They make Grand Theft Auto and NBA 2K, so a big gaming company. Then PTC at number 8. I've actually never heard of them, but apparently they're a modeling software company, so I guess it makes sense. Then ANSYS at number 9. That's a giant 3D design and engineering simulations company, so I do agree with that one there. And then Unity at number 10. That's a giant games engine company. It's kind of like the backbone of video games, so I also agree with that one too. Apple doesn't make the cut though. It comes in at number 11, which is a little surprising to me because, you think with how many smartphones they sell, and even with the new augmented reality headset, I know it's a very expensive one, but they have their own augmented reality headset too. So, I would have thought that they would have been a little higher, especially for also how profitable they are, how safe the stock probably is. I thought it would have made the top 10, but it's just under that. And actually, even more surprising than that, though, is that Microsoft didn't even make the top 10. That is insane to me because they have Xbox. They spent like $70 billion to acquire Activision Blizzard. Clearly, this ETF, this index does care a lot about gaming. I mean, Microsoft is huge for gaming. They own Windows, so basically every PC in the world, like every computer in the world, is running on their platform. And they also have Azure Cloud. I mean, a ton of the metaverse is probably going to run on Azure. So that's crazy to me to not include Microsoft in the top 10, especially for how profitable they are, how safe the stock is, all the other things they do. So yeah, that's crazy to me. Even Google too is not in the top 10. They have a big cloud platform. They have Android. Basically, it's like more popular than even iPhones. Like the majority of phones is actually on Android as opposed to iOS, more so on Android. So I would have had them in the top 10 too. Okay, I'm not a big fan of this top 10 list, but let's see what else makes up this ETF. We'll go through it in just very fast rapid fire style. So I'm going to change the website though. It's almost the same rankings, but it's just going to be a little easier to go through the list. So scrolling down to Apple, right after that is Garmin at number 12. They're big wearables and GPS company, but I wouldn't have them anywhere near this high. I think that's a very hard market to compete in. There's also a few Chinese gaming companies, but my favorite is by far Tencent. They're the giant behind Fortnite. These are Asian companies, but Tencent, they have Fortnite. They used to be they used to generate like the biggest gaming revenues. That's probably been overtaken by Microsoft recently after they acquired Activision, but they're huge in gaming, but they also do a ton of stuff in AI. They do a ton of stuff in cloud computing. So I agree with Tencent being high up. Maybe it could even be higher. But anyway, Ubisoft, I believe that's a French gaming company. I'm not a big fan of them, though. And then finally, all the way down to number 21, they finally include Microsoft at less than 3% exposure. They should be so much higher than that. I would probably put them like in my top 5 or top 3, maybe even at number 1. Microsoft might even be number 1 for me. Zoom Video at number 22. That makes sense for business, work, and education. NVIDIA right under them at 23. I would put them way higher than that. They'd be like in my top 10 for powering the metaverse with their GPUs and even for their work in augmented reality and what they call the Omniverse. They should be way higher in my opinion. And then Google is right under them at only less than 1.5%. That's criminal. I would for sure put them in my top 10 too. Then we have Samsung, big smartphone maker. Adobe, huge for content creation. I like them, but they only have less than 0.5% for that one. And then all the rest of these here are actually less than 0.5% too, with some more chip stocks like AMD, Qualcomm, Micron, Intel, SK Hynix. These are getting very tiny in terms of exposure though. We have Nintendo, one of my all-time favorite gaming companies, but they're all the way down to just 0.08% exposure. And then we have Match Group at only 0.02%. I actually like them for online dating, which could also be really big in the future for the metaverse. And I believe they own Tinder and Hinge and a few other very popular dating apps. So that would be one that should probably be higher. And then, man, how the mighty have fallen. Snapchat all the way at the very bottom there. Kind of a disaster of a company that just can't really compete anymore with the big dogs like Instagram and TikTok and stuff like that. So yeah, overall, I would say that I am not the biggest fan of this list. It's not that it's a bad list, but I just don't agree with the overall structure of it. Like having companies like Microsoft, Google, Nvidia so incredibly low just doesn't make any sense to me. I would move those right up to the top. I would make some huge balancing changes. I would take a bunch of the riskier ones that they have at the top. I'd put those at the bottom. I'd take a lot of the safer ones, move them higher. I would make some huge changes to this. And that really brings me to what has always been my biggest issue with ETFs. Like I always get comments from viewers telling me that I should invest in ETFs because I can get so much broad exposure to certain areas and stuff. But the problem is that when I look into them, a lot of times I just don't agree with how they're structured. And even in this particular case, I think it's great for giving exposure to the metaverse. I agree with a lot of the stocks that they have on the list, but I don't agree with the structure of it. I think they made some really weird choices. And when I look through the list too, I actually own some of the best ones. Like the ones that I like the most for the metaverse on this list, I actually own most of them. So I'd rather just pick the ones that I like the most and leave out the other stuff that I feel is kind of not necessary. So yeah, that's kind of how I feel about ETFs. Like when I look at ETFs, a lot of times I'm just like, man, I could just like, yeah, I like this one, I like this, I like all these stocks. I'd rather just pick those stocks and invest in the best ones, invest in the ones that I like the most, and then the other ones, if I don't like them that much, I don't really want them. So I don't know. You guys will have to tell me how you feel about this. That's just my opinion. We can all have our different views and opinions. Again, I'm not trying to bag on ETFs. I think that they are great for their specific purpose, and if they're used for your specific goals, they can be great for that. And you want like passive investing, you want to invest in something specific area, and you don't want to have to worry about it too much. You don't want to have to keep track of everything. Just kind of let a big company like BlackRock manage it all for you. I think that's great. I think it's totally fine. But for me, it's just not something I'm into. I like picking all my individual stocks. So that's how I feel about this one. But let me know what you all think. Do you like this ETF? Are you thinking about buying this ETF? Or do you like just a bunch of the stocks from it and you'd rather just kind of handpick those yourself for the long term? I'd love to hear your thoughts. Leave them down below, everyone. I hope you're all doing well. Thanks again for stopping by, my friends. And I will catch you in the next video. All right, take care, everybody. Bye-bye.